Hi Jason, thanks for joining us today to talk about the IML Equity Income Fund. Now the fund's been up and running for 2.5 years now. Just wondering if you could give us a bit of background on the objectives of the fund.
Thank you, Sam. The objective of the fund is to deliver high income distribution to our unit holders. And over the long term, we envisage that we can deliver 7 to 10% per annum to our clients. And it comes from multiple income sources. The first and foremost would be from dividends from stocks, but there would be a significant portion coming from option strategies that will deliver another layer of income source. And finally, obviously, if you're picking good stocks over the long term, you'll get some sort of net realised capital gains.
Now the fund has managed to provide unit holders with a very healthy income stream throughout the last year and since inception. Just wondering if you could comment a bit more on how you use options within the fund to generate that additional income.
Yep. So option strategies are used as an extension of our buy and sell discipline. So we all understand that we should buy stocks when they're really cheap and sell stocks when they're really expensive. But it's the area in between that we can implement option strategies to actually derive further income for the portfolio. So for example, if stocks are becoming more expensive, we can sell call options on top of our stock as an exit strategy for that position. And even if the stock rallies further, we would lose the stock and we'll be happy with it because of valuation reasons, but we would have earned the income associated with the option. On the flip side, if the stocks are becoming cheaper, we can sell put options on the stock with the strategy of gaining entry into that particular company. And again, if the stock falls lower, we would be happy to own the stock, but we would have earned the option income.
Thanks, Jason. And maybe just an example of where you've used this strategy recently with a stock.
Okay, so here is an example of Woodside. So back in March 2012, Woodside was trading around $32. At that point in time, we decided to sell a put option on the stock because we felt that was compelling value associated with the company. By selling that put option, we gained $1 in option income, which generated quite a healthy level of income for our unit holders. At that point in time, the market was quite bearish on the company, and that's why the stock price was fairly weak. And in fact, by June 2012, we actually got assigned that stock at a much lower price. We were still happy with the $32 entry price, and like I said before, we earned $1 on that. Through time, the market realized the true value associated with Woodside, and you can see how the share price has re-rated through time. And as it approached the top end of our valuation, closer to $38, we decided to sell call options on top of that, around that share price level. And because options don't last forever, we continue to roll the call options further and further through time and picked up significant call option premium through that time period. And also because we owned that stock through that time period, we also picked up 3 levels of dividends from the company as well. So in effect, if you add up all the income that we generated from the put options, the call options and the dividends, we generated close to 18% income return associated with that strategy.
Okay, great. And Jason, what has actually been the income for the last 12 months and since inception for the fund?
The income generated over the last 12 months has been quite solid. For the FY13 year, the income return for the fund has been 9.1%. If you include the imputation credits associated with the income, the grossed up yield has been around 10.7%. Since inception, again, the income has been quite strong. Net income return has been around 11%, and again, grossing up for imputation credits, it's around 12.5%.
Okay, and you've obviously talked about the income, Jason, but the other side of that is obviously capital preservation and how important that is. How do you approach that within this fund?
So delivering yield without any consideration associated with capital is a disaster, because the last thing you want is to deliver an income return but destroying capital. So hence, it's paramount for this fund to actually preserve capital just as much as having a strong focus on delivering income. So the way we do it is by focusing on companies with strong value characteristics and strong quality characteristics. By focusing on companies with both those attributes, there's less likelihood of capital being destroyed over the long term.
And lastly, Jason, look, obviously with the fund being focused on income, who would you suggest this particular portfolio would be suitable for?
Because the fund has a high focus on income, it is suitable for anybody who's seeking that type of objective, and such as retirees. As we all know, retirees demand two things from their investments: high levels of income and high levels of capital preservation. And since inception, this fund has delivered on both accounts, but with a quite transparent investment process, with an options overlay that is an extension of our buy-sell discipline.